Understanding Investments a Few Minutes at a Time by Daniel Dower. From Chapter 4, Investing Nomenclature. Issue number 17, Bonds. Bonds represent loans made to a company, divided into shares of each loan. A company issues $1 billion in bonds at $1,000 each. An investor holding 100 shares of these bonds owns 0.01% of that particular loan. A trustee administers the bonds, collecting interest payments from the company and distributing them to the bondholders and, if necessary, taking legal action to protect bondholders. Typically, bonds pay interest twice per year, with the principal returned at maturity, but details may vary. For a fee, companies such as Moody's or Standard & Poor's rate bonds based on their perceived safety, the likelihood all interest and principal payments will be made. The grading scales and qualifications vary by rating agency and are divided into categories such as investment grade or junk bonds. Based on these ratings, bonds will be priced to include a credit premium. Their higher yield will be higher for poorly rated companies and lower for well-rated companies. In 2013, only 4 private companies received a AAA credit rating: Automatic Data Processing, Exxon, Johnson & Johnson, and Microsoft. AAA bonds may trade for 40 or 60 basis points over the risk-free rate, the equivalent duration U.S. government bond, whereas junk bonds may trade for up to 1,500 basis points or more above the risk-free rate. The bond industry uses the term basis point to represent 1/100th of 1%. Therefore, 400 basis points means 4%. In addition to companies, government agencies also issue bonds to fund their capital needs. Government bonds, local, state, and federal, may have further special benefits or restrictions. In most circumstances, municipal bonds, local and state, are free of federal income tax, and usually states taxed in their state of issuance. Federal bonds are also referred to as sovereign bonds or sovereign debt. Virtually every country in the world issues sovereign debt, usually in its own currency, but not always. Bonds can be deceptively complex, and few retail investors buy individual bonds. In addition to having varying coupon rates, the amount of interest paid, usually twice per year, bonds usually trade at a discount or premium, depending on current market conditions. Further, there is no central public exchange like the New York Stock Exchange that provides simple pricing and trading. Institutions and wealthy investors use specialists to facilitate their bond holdings. Most ordinary investors invest in bonds through bond funds, similar to mutual funds for stocks. Ordinarily, bonds are considered the safest way to invest in a company, because in the event of bankruptcy or other financial stress, bondholders get paid before stockholders, and depending on the bonds, often in front of other creditors. However, default risk is not the only concern. Some bonds are highly liquid, such as U.S. Treasuries. Others are not. During the late 2008 financial crisis, many companies were left holding the bag after having purchased auction-rate bonds. These bonds had longer durations, but were submitted for auction periodically, as often as weekly, giving the illusion of liquidity, as an owner could submit their bonds to be sold in each auction. However, during the crisis there were no buyers. In order for a security to be liquid, we not only need the legal capacity to sell it, we need willing buyers. Interest rate risk is of equal importance. Even AAA bonds with long durations are subject to interest rate risk during their holding period. If interest rates fall, the bonds become more valuable to the prospective buyer. If interest rates rise, the bonds become less valuable. If you buy a $1,000 10-year government bond today at 3%, and next year the interest rate rises to 4%, its value will drop to $925. You should be cognizant of the interest rate risk associated with long-term bonds. In general, if you're able to hold your investments for a long period of time, returns on equities are higher. Some bond funds ladder their bond durations, for example, buying bonds that mature 10% every year for the next 10 years. Doing so will mitigate the interest rate risk, but the yield on shorter-term bonds is lower, and therefore the total return on funds with shorter durations will be lower. Many investors perceive stocks and bonds as being inversely correlated to one another. More often than not, market forces that drive stocks down drive bonds up. Thus, keeping a portfolio balanced between stocks and bonds will offer some protection against a market downturn. The recent financial crisis shattered much of that belief. In a severe crisis, even bonds may be perceived as risky due to default risk, interest rate risk, currency risk, etc. If so, their value may fall as well. Many bonds contain special provisions, such as the option to convert to stock or the ability of the company to redeem the bonds early. As they may come in endless varieties, I will not delve into that here. In Security Analysis, Graham and Dodd discuss bonds at length.